Hey there guys, John.Hunter, your mortgage hunter, coming back to you again with another weekly rate update, this one for October 25th. So hey guys, I'm back again with a little 2-week hiatus, not doing anything fun, just wasn't able to record it the last 2 weeks, but you really didn't miss much. You know, the rate roller coaster has continued, you know, with rates edging up since the last time I did this report. 30-year fixed 6.125 to about 6.75. 15-year 5.75 to 6.5, FHA 6.5 to 7, VA 6.375 to 7, down payment assistance 5.75 on the low end to about 7.75. Remember guys, you know, loan amount, credit score, loan type, property type, sometimes even state, income, whether you're a first-time home buyer, all of these things play a role in these rates, guys. So if you want an individualized quote, let me know. I'd love to give it to you. Sometimes rates are a little bit better than this. Sometimes they're worse. It kind of depends, right? Always the standard answer when it comes to rates. It's so hard to nail down. Anyway, so rates are roughly about 0.5% higher since September. And you know, what's driving that? You know, it's all over the news. Oh, rates were cut, whatnot. And that's true. The Fed cut rates. Now, look at this chart, guys. Look, here's a little chart that shows you the 10-year Treasury bill. Now, the thing that's important about the 10-year Treasury is the 10-year Treasury mirrors interest rates. So as the yield goes, so does mortgage rates. Now, don't pay attention to the numbers so much, that 4.21, I believe it is. Don't put too much weight on that. That does not equal a rate. So it's not 4% rate, right? That's just a yield on the 10-year Treasury. What you're looking for here is as that yield goes up, rates go up. And as that yield comes down, rates go down. It's a really great tool to track what interest rates are doing without being sold something. If you ever look on the internet and you Google anything about mortgage rates, you get nothing but ads, right? So this is a way you can track it independently. It doesn't cost anything. That information's out there. Often on the news, when they talk about the Dow and the NASDAQ and S&P and whatnot, they'll talk about the 10-year Treasury. So as that yield goes up or down, so do rates. So look at the chart here. We, back in the beginning of August, you see the rates start to drop. That's when all the news was, hey, the Fed's really going to cut rates a lot in September, not just 0.25%. We could be looking at 0.5 or even 0.75, and you saw the rates improve. And then right before the Fed cut, you see my little arrow that says when the Fed cut, you know, the market started to be, to do a little hedging against maybe the Fed disappointing. So you see that edged up a little bit right before the cut, and then boom, they cut. Made some great comments that made the market feel better, and you see the rates drop a few days, a week after the Fed cut. And then we started getting economic news that's saying that hey, the economy's not as weak as maybe they expected, that unemployment isn't as weak, that some of the numbers came out a little stronger than expected. So now the market is completely second guessing itself, thinking, well, maybe the Fed acted too soon. You know, the quarter cut it originally in November. Now they were anticipating maybe 0.5 or even 3/4 in November, and maybe more in December, that the Fed was going to have to get more aggressive. That's why we saw rates improve so much, guys. That's why you saw that dip, is they were anticipating the cuts for November and December were going to be greater. Now with that economic news that have come out, we've seen all of the gains from that last cut get erased. If you look at the chart, we're at a 3-month high now. We're higher than we were back in August before the September cut. This is not unheard of, guys. So the last 6 rate cycles, this exact scenario happened, right? When the Fed started to cut rates, within 30 days of their rate cut, rates were higher. And that's actually happened here again. So I had to look back on this because I don't remember this happening last time because it was a while ago. But it did. It actually surprised me that this happened the last 6 times. There's zero correlation, come to find out, between this anomaly of rates going up after the first rate cut and the equivalence of the future rate cuts. So basically, even though the market is hedging, maybe the Fed isn't going to be as aggressive as they thought, it doesn't mean the Fed's not going to be aggressive. And it certainly is not a sign that we're not going into a recession, or all of the data points that were there making think the Fed was going to be more aggressive doesn't mean that anything's changed. right? This just happens to be an anomaly that happens every time the Fed cuts, at least the last 6 times, and it does not correlate to the long-term forecast of lower rates sooner than later, and that the Fed may be forced to act aggressively. Now, you add 2 more things to this mix, and this is where it gets so interesting for me. I kind of geek out on this stuff, if you haven't already noticed. But we have, of course, the elephant in the room is the election, right? If you've listened to any of my comments on the market prior, you'll know that I'm a little bit of a conspiracy theory in this, in that the information we're getting out of the government is not even worth the paper or the air from when they announce it, right? I think that it's BS. I don't think that their employment numbers are even remotely close. And this is based on their own reporting on the corrections every single month, correcting it down greater than the margin of error. And also that one-time million person adjustment they made, which really makes all of the numbers over this last year absolute garbage. So we're getting more of that. And I think there's a political tint on that, the government. And this is not a Democrat or Republican thing. I think all administrations do this. They try to make it look a little rosier to maybe get those on the fence voters, right? That the economy is not so bad. Well, it's all smoke and mirrors. We all know what we all feel, that we're paying a lot more and our effective income is less than it has been. So it's just a political posturing, I think, right before the election, which, as everybody knows, is only a little over a week away, 10 days or so. So I believe that portion will shake out right after the election. And then there's another risk factor that, if you watch the news, I'm sure you've watched this, but may or may not have thought about it, is that Iran attacking Israel a few weeks ago, it's clear that not if Israel is going to retaliate against Iran, it's when, how severe, what are they going to attack, right? So there's a couple theories on this, right? If they go after the nuclear sites in Iran, could escalate very quickly. Obviously, Iran is not going to take that very lightly. And some people think it's due, that it should happen, that, that they're evil. Regardless, the other options are take out the leadership in Iran, which is also very destabilizing, because you get one bad guy get replaced by another bad guy, and he might be worse. You just never know. So there's a lot of uncertainty there. The one scenario that a lot of people have talked about is knock out Iran's oil fields. And this is the one that is affecting the rates, right? It's not just the instability and the unknown of these attacks. It's the escalating into a further conflict. And more importantly, even if it doesn't escalate into a further conflict, there's a threat of, if we attack the oil fields in Iran, Iran has already promised that if they do that, they're going to attack our allies' oil fields. That's Saudi Arabia. That's United Emirates, right? There's quite a bit of, that's a target-rich environment for the Iranians, and, that dome that they have to protect Israel is not going to help with Saudi Arabia or the Emirates. I'm sure they have plenty of their own defenses, but still, it's going to disrupt oil internationally, which is going to drive oil up significantly overnight. As soon as Iran or Israel attacks Iran, if they take out the oil fields, we're going to see a big spike in oil, because everybody's going to be afraid of that supply is going to hurt international costs, because it's a commodity. Well, that's hugely inflationary. A big part of all the inflation we've got over the last couple of years is energy prices. So it drives everything. So there's a lot of hedging and there's a lot of unknown there. And that has actually driven rates up while everybody's kind of waiting to see what happens. So you've got that, you've got the election, right? And I think you have, all the smoke and mirrors that's happening right now with the reports coming out of the Bureau of Labor Statistics. So basically, the long and the short of it is, I wouldn't lock right now. I don't think these rates will be here for much longer. I think they're going to come down regardless of what shakes out. If we get a Republican in the White House, I think you're going to see rates improve very quickly. He's made a lot of commitments to making energy cheaper, especially for Americans. And I think it'll add stability to the world. I'm not making any political statement here other than this is just facts, right? Not emotions, this is facts. So I do believe that will stabilize things. So we'll just have to see how that all works out. But ultimately, I think it's coming down either way. And I do believe it'll be before the end of the year, which is part of this little roller coaster. But the reason why I wanted to give you that backstory on this is to understand that this is actually normal. This is the way the markets work. It's frustrating, very frustrating for somebody in the business when I have people coming to me that want to buy a home 30 days ago, and then they find a home this week and the interest rate's higher, right? And when you hear nothing on the news but, oh, rates were down, right? Nobody's talked about how rates have gone up since then. As you saw the chart before, it's pretty clear, right? But just like everything else, you know, when rates go up and rates go down, it's never a straight line. That's what I always say. So it's never a straight line, but it doesn't stop that the trend is going to be down. So hang in there, guys. We're almost through it. It should be an interesting next 10 days or 2 weeks until the election all shakes out. And I think a lot of these unknowns will shake out. Hopefully Israel's response is proportionate and I don't wish for anybody's death or destruction. Just stability and peace, and hopefully that will shine through in the end. So, hey guys, have a wonderful weekend. I'm staying on top of this. Come back. I will be talking about what matters on interest rates. And hey guys, once again, if you are looking to buy a house or want to refinance, I'm your guy. I always give you the advice that I would give my family or do myself, knowing what I know. And hopefully you'll reach out and become a client for life. That's the goal. So, hey, like, subscribe, and have a wonderful weekend. Hey, go Cougs, playing again. They're bowl eligible. We'll see if they can end the year strong. So, you know, the Pac-12 is Pac-2, you know, so they're in number 1. But we'll see how they end the year. So, all I know is they beat the Huskies, and that's all I care about, right? That's usually the sign of a good season, even if they lost every game. I think the Huskies are not real happy about that. So go Cougs, have a great weekend, and I will talk to you soon. Bye-bye.